Bitcoin volatility hits a historic low. Fidelity Digital Assets says Fidelity Digital Assets said on August 19, 2026 that Bitcoin's volatility has dropped to one of the lowest readings in the asset's history, lower than roughly 98.5% of all trading days since the network launched. The statement, posted through Bitcoin Magazine's coverage of a Fidelity Digital Assets note, lands in the middle of a stretch where Bitcoin has moved very little in either direction. The price backdrop supports the claim. Bitcoin traded near $64,594 as of August 19, 2026, up about 0.6% over 24 hours and roughly 0.8% over the past week, according to CoinMarketCap market data. Ether sat near 119.25, up 1.3% on the day. The Crypto Fear and Greed Index read 41 in neutral territory. None of those numbers describe a market lurching around. A quiet tape after a violent year, the low volatility reading follows a rough stretch for Bitcoin. BlackRock, in a separate note the same day, characterized Bitcoin's earlier drawdown of roughly 50% as the result of deleveraging rather than any change to its long-term investment case, and reaffirmed a 1% to 2% portfolio allocation. That framing matters here. Forced selling and unwinding leverage produce sharp, disorderly moves. Once that pressure clears, price action tends to flatten out. Fidelity's point is that the flattening has gone unusually far. A volatility reading below 98.5% of all historical days means Bitcoin is calmer now than it has been in almost the entire record. For an asset that built its reputation on 10% daily swings, that is a notable shift in character, even if it says nothing about direction. Fidelity Digital Assets frames the data as a maturation signal. Deeper spot markets, a large base of exchange-traded fund holders, and more institutional balance sheet exposure all tend to dampen the size of daily moves. More hands that treat Bitcoin as a multi-year position, and fewer that trade it on hourly leverage, produces a steadier tape. Low volatility cuts in two directions. A calm market reads as reassuring, but low volatility is not the same as low risk. Compressed volatility has historically preceded expansion, not permanence. Option traders watch these regimes closely because cheap implied volatility can flip fast when a catalyst arrives, and the catalysts here are not hard to name. The September Fed decision, the Clarity Act cloture vote, scheduled for mid-September, and any surprise in macro rates. Global bond yields were already pressuring risk assets in the same session, per CoinDesk market commentary. For traders running leverage, a quiet market can lull positioning into complacency right before a repricing. This is speculative analysis, not financial advice, but the pattern of coiled volatility resolving into a large move is well documented across asset classes. Practical read for spenders and holders. Steady prices change the calculus for anyone spending crypto day to day. A holder funding a crypto card from a volatile balance faces the risk that a swing between top-up and settlement eats into purchasing power. A low volatility stretch narrows that gap, which is one reason many users still route spending through stablecoin balances rather than raw BTC. Stablecoin funding sidesteps the timing risk entirely, and it remains the default for cards that settle in fiat. For those chasing cashback rewards on card spend, the volatility reading is mostly a non-event. Rewards paid in stablecoin or fiat do not care what Bitcoin's daily range looks like. Where it matters is for cards that pay rewards in a native token or require staking, since a calm BTC tape often coincides with quieter altcoin markets and thinner reward token liquidity. The wider takeaway is narrow but real. Fidelity is not calling a top or a bottom. It is pointing out that Bitcoin, at least for now, is behaving less like a speculative instrument and more like a slow-moving macro asset. Whether that holds through September's regulatory and rate calendar is the open question.